Picture where we are right now, late 2025. Nvidia is trading near record highs. The AI infrastructure boom is still accelerating, and every major Wall Street firm is scrambling to raise price targets to justify valuations that would have been considered delusional just 2 years earlier. AI isn't an idea anymore, it's a capital allocation arms race. Data centers are being built faster than housing. Enterprise software companies are rebuilding products around large language models, even if they don't yet have a monetization plan. And the market, intoxicated by a narrative it doesn't fully understand, continues to chase anything with AI in the ticker. In this environment of absolute conviction, you'd expect the investors who rode the AI wave early to be doubling down, right? But one of them has quietly decided to do the opposite. A billionaire who rode Nvidia's ascendancy from prophecy to reality has now completely liquidated his position. Not reduced it, not trimmed it, not hedged it, zeroed out. Stanley Druckenmiller, a 40-year veteran of global macro trading, a man who turned $12 million into $12 billion, a man with a better real-world track record than almost any modern hedge fund, has exited the greatest technology trade of the decade, while retail is still buying dips and celebrating green candles on social media. And this raises the unsettling question. If he was right about Nvidia's rise, is he about to be right again about its fall? Because to understand Druckenmiller, you have to understand his worldview. He doesn't invest in companies. He invests in transitions. He hunts inflection points, moments where the narrative changes before the price does. And when he senses that the narrative is breaking, he exits positions not days before the crowd, but months before the crowd even realizes something is wrong. This is why he left tech before the dot-com crash, why he avoided the worst of 2008, and why he aggressively rode the early stages of the post-COVID asset bubble, then stepped aside when valuations reached escape velocity. He is not a guru. He is not a contrarian celebrity. He is a hunter of structural turning points. And right now, he sees one barreling toward the AI sector. The popular explanation for his Nvidia liquidation is that he's taking profits after a great run. But that narrative misunderstands how he thinks. Druckenmiller held Amazon through the late 1990s, across 80% drawdowns, because he understood that the internet's adoption curve would take time. He held Meta through controversies and boycotts because he saw structural dominance. He held semiconductors when they were boring because he understood that compute would become the new oil. He does not abandon winners because they went up. He abandons winners when the conditions that made them winners stop being reliable. And right now, the AI sector is facing a problem that most investors aren't even aware of. The gap between investment and monetization. The AI build-out phase is now in its peak expansion. Big tech has spent jaw-dropping sums building infrastructure, GPUs, data centers, training clusters, power infrastructure, networking gear. This spending is what sent Nvidia into orbit. But what comes after a build-out phase? A pause, while companies attempt to monetize the thing they just built. And this is where the risk emerges. AI monetization is slower than AI infrastructure deployment. Enterprise adoption is slower than enterprise experimentation. Revenue capture is slower than revenue promise. There is a 12 to 18-month period, historically, in every major technology cycle where the infrastructure has been built, but it has not yet generated revenue, and budgets are paused to assess ROI. This is what happened in the internet build-out. This is what happened in cloud computing. This is what happened in mobile ecosystems. And Druckenmiller knows that when spending pauses, companies like Nvidia don't gently drift lower. They get punished. Because Nvidia isn't priced like a normal company. It's priced like a perfect company. A company that must grow without interruption. A company that must deliver perpetually accelerating results. A company that must justify a $1 trillion premium before the world slows down. If the AI sector experiences even a modest slowdown, not a crash, just a deceleration, Nvidia's valuation collapses long before the business does. Druckenmiller isn't betting against AI. He's betting against continuity. He's betting that investors are underestimating the risk of a multi-quarter pause in AI spending. He's betting that CFOs will prioritize profit margins over hype. He's betting that the stock market is not prepared for a flat quarter, let alone several. And that's only half the story. Because if he simply exited Nvidia, you could argue it was a stock-specific judgment. But he didn't just sell Nvidia. He liquidated dozens of high-growth tech names. At the same time, he dramatically increased exposure to gold miners, precious metals, and cash equivalents. Ask yourself what kind of investor rotates from a sector with the highest forward growth expectations to hard assets, cash, and defensive plays. Someone who is expecting economic slowdown, liquidity contraction, higher default rates, multiple compression, asset repricing. Someone who is preparing not for a recession that is happening, but a recession that is not priced into markets yet. And that's what makes this moment so dangerous. Because retail investors are still buying Nvidia based on the rearview mirror, on what it did, on what it represents, on what it symbolizes. But Druckenmiller isn't operating in the rearview mirror. He's positioning for a future where interest costs, debt refinancing, and capital scarcity become the defining forces of corporate profitability, not technology narratives. And here's the irony. Retail investors believe they'll be nimble when the downturn comes. They believe they'll sell early. They believe they'll avoid losses because they'll see it coming. But the smart money, the hedge funds, the insiders, the corporate executives, do not exit during crashes. They exit before crashes when you are still euphoric, when you're still convinced that every dip is a buying opportunity, when you are still celebrating weekly green candles, when you still believe you're early instead of late. That's how systemic wealth transfers occur. They happen not because smart money steals from dumb money, but because dumb money enthusiastically buys what smart money is unloading. Not because retail investors are stupid, but because they're always the last to receive the information and the first to respond emotionally. Druckenmiller's actions are not a press release. They are not advice. They are not headlines. They are warnings, broadcast through allocation, not words. And here's the uncomfortable truth. If you're still heavily exposed to AI equities right now, you're betting not just on Nvidia, you are betting against Stanley Druckenmiller. You are betting that you understand macro conditions better than someone with 4 decades of elite performance, access to information pipelines you'll never see, and a track record of exiting bubbles months before they burst. And maybe you do. Maybe you're early. Maybe you're brilliant. Maybe this time is different. But ask yourself, what are the odds? There's a dangerous psychological trap investors fall into during late-stage bull markets. It goes like this. They assume that because a narrative is true, the stock prices associated with that narrative must also be justified. AI is real. Nvidia is dominant. Tech is transformative. All of that is true. But none of it guarantees that the valuations assigned to those realities are sustainable, especially during macro compression. A great story doesn't prevent a great stock from falling 50%. It just gives people something to blame afterward. The market did this in the late 1990s. Investors said, "You're missing it. The internet changes everything." They were right. It did. But it didn't change the fact that Cisco, Yahoo, AOL, and dozens of other legitimate, world-changing companies lost 80% or more during the valuation reset of 2000 to 2002. The innovation was real. The valuations were not. That is the exact same dynamic we're facing with AI. Even if AI fundamentally rewires the global economy, which it probably will, it doesn't mean Nvidia, Meta, AMD, or the entire AI sector rises in a straight line indefinitely. Innovation moves in waves. Finance moves in cycles. And those two forces are not synchronized. Right now, the financial cycle is flashing red. High interest rates aren't just a one-quarter inconvenience. They are a systemic filter exposing balance sheets that only survived because cheap credit papered over structural weaknesses. Tech giants are not immune to this. AI capex is fueled by cheap capital, risk appetite, loose monetary policy, aggressive growth targets. But what happens if those conditions reverse? What happens when the CFO of a trillion-dollar company realizes that financing $50 billion worth of GPU infrastructure now costs 2x, 3x, or 4x more than it did in 2021? This is the part Wall Street isn't pricing in. The borrowing binge of 2020 to 2021 wasn't free. It was delayed pain. And that pain comes due during refinancing cycles. In late 2025 and throughout 2026, corporations across the world will hit the refinancing wall, where the cheap debt they issued during zero interest rate policy, ZIRP, years expires and must be rolled over into a world with structurally higher interest rates. If your interest expense triples, where does the difference come from? Headcount reductions, R&D cuts, capex delays, lower margins, slower growth. And in AI land, the most expensive line item is infrastructure build-out. If you're a CFO tasked with protecting margins in a tightening economy, the first thing you cut is discretionary spending, especially spending that doesn't produce immediate returns. AI spending is enormous, but its payoff is uncertain. And nothing terrifies public markets more than uncertainty. This is why Druckenmiller's exit matters. He isn't saying AI is fraud. He's saying the payoff curve may not match the hype curve, and millions of investors are positioned as if the next 12 months will look like the last 12 months. But technology cycles don't work that way. They have build-out phases, monetization phases, pause phases, and those pause phases can last years. The pause is where valuations compress, not because the company failed, but because expectations reset. And here's the sinister truth. Wall Street analysts don't warn you when the pause begins. They warn you after the carnage has already started. They upgrade targets at the peak. They downgrade at the bottom. It's not because analysts are stupid. It's because they're reactive. They live inside consensus. They follow price action, not anticipate it. Druckenmiller doesn't wait for analysts. He leaves before they update their models. Which brings us to the most misunderstood part of this entire story. Smart money doesn't sell because they're bearish. They sell because they're done. When Druckenmiller exited Nvidia, it wasn't a protest. It wasn't a hedge. It wasn't a warning. It was closure. He harvested the entire return profile he believed the trade offered. He didn't try to squeeze the last 10% out of the bubble, because he knows that the last 10% belongs to retail. Every bubble ends the same way. The professionals sell to optimists. The optimists sell to dreamers. And the dreamers hold while the market implodes. The myth is that investors get trapped because they panic. But history shows they actually get trapped because they refuse to panic when they should. They hold not because they're disciplined, but because they believe they're special. They believe that they will recognize a crash early. They believe they will exit quickly. They believe they will avoid pain with timing. But crashes do not unfold as movies suggest. You don't get clean exit signals. You don't get gentle red candles. You don't get time to think. Crashes happen like explosions. Liquidity disappears first. Price discovery collapses second. Markets don't fall in a straight line. They gap. This is what retail never understands. You don't lose money during the crash. You lose money during the gap when there is no bid to save you. The moment you decide to sell, it's already too late. And here's where Druckenmiller's strategy becomes lethal in its simplicity. He exits not when the chart is weak, but when the chart is too strong. He doesn't sell when demand falls. He sells when demand peaks. He sells when liquidity is optimal. He sells into acceleration, not weakness. Retail thinks this is leaving money on the table. Professionals know this is harvesting liquidity from the crowd. This is the part most investors will never internalize. Professional exits don't happen during fear. They happen during euphoria. Fear crashes markets. Euphoria fuels exits. Right now, Nvidia is euphoria. AI is euphoria. Tech valuations are euphoria. And retail investors are convinced that if they hold long enough, they'll be rewarded. They've internalized a narrative that sounds intelligent, but is actually fatal. Long-term investors always win. This statement leaves out a critical detail. Long-term investors who buy low win. Long-term investors who buy late get wrecked. And Druckenmiller is not signing up for that experiment again. He built his fortune by being early. He preserved his fortune by exiting early. He does not participate in the final phase of bubbles, not because he's bearish, but because he's indifferent. He does not chase the last dollar. He hunts the first dollar. And that difference in mindset is what separates the builders of wealth from the holders of bags. So when you see him abandoning Nvidia, Meta, AMD, and other AI names, it's not a prediction. It's a posture. A posture of defense. A posture of patience. A posture of preserved optionality. Because optionality is what gives you the right to buy when others are suffocating. And Druckenmiller is positioning for a time when suffocation is abundant and liquidity is scarce. That time is not now, but he believes it is soon. There's a reason crashes feel unpredictable to most investors. They're looking for catalysts instead of conditions. They're waiting for the headline, the event, the spark, the black swan that justifies panic. But markets rarely collapse because of a single blow. They collapse because the foundation has eroded quietly, invisibly, and irreversibly. The headlines just tell you what broke. The conditions tell you why it was guaranteed to break. Today, the market is sitting on a foundation that looks stable from the surface, but is increasingly fragile underneath. Corporate debt maturing into higher rates. Profit margins under pressure. Consumer savings depleted. Fiscal policy constrained. Monetary policy trapped. Global growth slowing. geopolitical risks elevated, liquidity drying up. And into that environment, we have injected a speculative mania around AI, a sector that now carries not just optimism but obligations. Because once valuations reach a certain level, markets don't accept growth. They demand hypergrowth. They don't accept progress. They demand acceleration. They don't accept success. They demand surprise. Nvidia isn't being valued as a dominant tech company. It's being valued as the sole engine of a multi-trillion-dollar paradigm shift with no stallout, no pause, no plateau allowed. Anything less than perfection becomes disappointing. Anything less than acceleration becomes failure. This is the paradox of success in late-stage bull markets. The higher the price, the more fragile the story becomes. Because price stops reflecting what a company is and starts reflecting what a company must become to justify its valuation. And when reality fails to match the story, even slightly, the correction isn't linear. It's violent. Druckenmiller understands this because he's lived through it. He's lived through the internet boom, the 2008 crisis, the post-QE melt-up, and the COVID-era explosion. He's seen euphoria turn into despair, and he's watched investors lose fortunes not because they bet on the wrong idea, but because they bet on the wrong timing. Timing is the invisible killer of wealth. The world is full of investors who were right too early or right too late, but financially ruined in both scenarios. You know who survives? Investors who are right about when, not just what. This is why Druckenmiller is prioritizing defense in late 2025, not because AI isn't transformative, but because the transformation is priced in too early. He's not leaving because the future is bleak. He's leaving because the present is overpriced. He's not abandoning a revolution. He's abandoning a bubble. And bubbles aren't defined by fraud. They're defined by valuation dislocation. They end not because investors get smarter, but because the math stops working. And the math is about to stop working. Because beneath the AI narrative, the global economy is entering a period where cash flow matters again, where capital costs matter again, where risk premiums matter again. A world where companies must justify spending instead of bragging about it. A world where efficiency beats experimentation. A world where storytelling doesn't outrun accounting. In that world, Nvidia isn't a bubble because AI is fake. It's a bubble because expectations are ahead of execution. And execution takes time, more time than investors are pricing. That's the mismatch Druckenmiller is avoiding. Not a technological failure, but a temporal misalignment. A gap between investment and profitability, hype and adoption, narrative and earnings. A gap where valuations can collapse even while the technology continues winning. This is why legendary investors don't try to capture full upside. They capture sufficient upside, then preserve capital until the next cycle. Because the true wealth in markets isn't made during expansion. It's made during contraction, when assets are mispriced, margins are squeezed, and forced sellers flood the market with discounted opportunities. Smart money doesn't get rich because it holds through crashes. Smart money gets rich because it has cash during crashes. Cash isn't cowardly. Cash is patient. Cash is an option on all future opportunities. And Druckenmiller wants that option available when panic, not greed, is driving price action. Right now, most investors are still trapped in optimism. They believe that momentum equals safety, that higher for longer is a fairy tale, that big tech is untouchable, that AI is too important to fail. But markets don't punish bad ideas. They punish good ideas priced as perfect ideas. And Nvidia isn't priced as a great company anymore. It's priced as a flawless destiny. No company ever sustains that destiny uninterrupted. Not Microsoft, not Apple, not Amazon, not Tesla, not even during their most explosive phases. Markets reprice leadership all the time. Not because leaders lose dominance, but because investors lose patience. The same investors screaming to the moon in 2025 will be screaming what happened in 2026. And Druckenmiller's move shows you exactly what he expects to happen. A slowdown in AI spending. A pause in infrastructure build-out. A tightening of corporate budgets. A contraction in earnings. A repricing of tech multiples. A liquidity shortage. A sharp correction. Not a collapse of civilization, just a return to math. And the return to math is always brutal for companies priced beyond reason. So here's the uncomfortable question you need to ask yourself. Are you positioned for the story you believe, or the math that is coming? Because if you're holding Nvidia, AMD, Meta, Palantir, and other high-growth AI names at peak valuations, you're not betting on technology. You're betting on narrative. You're betting on momentum. You're betting on sentiment. And sentiment turns faster than fundamentals. The future may belong to AI, but the next correction belongs to cash. And Druckenmiller is choosing to hold the latter, not because he doubts the former, but because he respects the cycle. You don't have to agree with him. You don't have to sell anything. You don't have to adopt his worldview. But you should understand his logic before the market forces you to learn it the hard way. He was right about the AI boom. He was right about Nvidia's dominance. He was right about the last 2 years. But his real genius has never been identifying innovations. His genius has been identifying endings. He doesn't invest in beginnings. He invests in turning points. And when he walks away, it's rarely because the party is over. It's because the exit is still open. Most investors don't leave during celebrations. They leave during chaos. The professionals leave early. The amateurs leave late. The stubborn never leave at all. And markets punish all three, just in different ways. So while everyone else is asking, is AI the future? Druckenmiller is asking the more important question. Is now the right price for that future? And his answer, based on his actions, is not vague. It's zero. He wants zero exposure. Not because he hates Nvidia. Not because he fears AI. But because he refuses to be trapped in a valuation storm that he sees forming before everyone else. Bet against him if you want. Maybe you'll be right. Maybe you'll be early. Maybe you'll get lucky. But if the man who predicted the boom just walked away from the table, you should at least ask yourself, what game does he think is about to begin? If you want to understand the next major turning points in AI, tech, and the global markets before everyone else reacts, make sure you subscribe to the channel, turn on notifications. Because the next phase won't reward those who chase narratives. It will reward those who see the cycle before it hits. We're breaking down the signals, the strategy, and the psychology behind the biggest wealth shifts happening right now. Don't wait for headlines. Don't wait for panic. Don't be the last to know. Hit subscribe and turn on the bell so you don't miss what's coming next.